Exciting thing for silver. This is almost a better setup than the gold one. Gold will lead, but this one is pointing to a disproportionate reaction given how hard it sold off here. It almost had its worst sell to start. Silver got properly spanked on that first instance. You were nigh on a 50% correction. So silver was flatter on the down leg and the recoil rebound. But since then, the compression from these levels has been far less. So what's actually happening for us is that you're in a creation of a more low vol third move. It shoots a little bit beyond to the upside, then a little to the downside, then a beyond to the upside. The crown element, the spikiness, that's called complexity. If we're trading at 84 tomorrow, I'm wrong on the falling wedge in terms of my expectation. This kind of bounce on gold and gold leads, I really think the 3.5 grand callers are going to be caught short. I don't think you're going to be seeing that. That is the goal. And it's a tough discipline because I'm a natural bull on gold. I want to buy every dip. There's a difference.
Me too. Me too.
There's a difference in terms of the investment persona. So I'm talking about where when you are trading, entries truly matter.
Yes.
When you are macro long-term on your blue pot, which is deleveraged, it is just money that you put away, you don't really need right now, and it's going into the savings and investment pot. You don't have that same sensitivity to entry. And that's a very important distinction. Trading is a different kettle of fish. You've got to be more accurate and you've got to be far more disciplined. And I say often, and I talk about this, people have to earn the right to utilize leverage.
Yeah.
And most people don't get to that point. Just because they've invested a couple of times before and just hodled on while they were distracted by working and doing other things, doesn't mean you're going to be a great trader. You need a real methodology if you choose to trade and you start to use a little bit of leverage. And that's what we focus on with the HVF method. The exciting thing for silver is this is almost a better setup than the gold one.
Most investors think holding through volatility makes them skilled, but that's exactly where the illusion begins. As Francis Hunt points out here, the real divide isn't bullish versus bearish. It's disciplined trader versus passive holder, especially when leverage enters the equation. Since 2022, rising rates have punished undisciplined leverage across assets, yet retail still confuses survival with skill. The uncomfortable truth is most portfolios are built on timing luck, not repeatable systems. And when volatility spikes again, that gap gets exposed fast. Next, Francis Hunt discusses why silver may offer a more asymmetric opportunity than gold right now.
Gold will lead, but this one is pointing to a disproportionate reaction given how hard it sold off here. It almost had its worst sell to start. And I want to just highlight there is a difference here between silver and gold. Silver got properly spanked on that first instance. You were nigh on a 50% correction. You were at 121.67 and then you're down at 63 at the low. Now, if you double that, that takes you to 126. You're nigh on 50%. You're probably knocking on a 45% correction. Gold being more robust held up better in the first instance, but had a far nastier sell-off period here. You know, once it was quite clear we were selling off for a second, and it had an extended second sell. Silver has shown that actually it was more robust because it had taken a bigger beating first time. It didn't rally as high as gold. So remember, I highlighted that you did a 78.6. So silver was flatter on the down leg and the recoil rebounds. But since then, the compression from these levels has been far less. So actually on a relative strength basis, since this sell-off occurred again, silver's been stronger. And we prefer this overall structural pattern, which you might note. I'm just going to hide my point and figure tool that has been doing some draws there as well, and just show you the falling wedge. So this is a beautiful and classic technical setup.
Headlines say gold is the safe haven, but the data quietly points to silver building pressure underneath. As Francis Hunt points out here, a near 45 to 50% correction in silver versus gold's relative stability sets up a classic overreaction trade. Historically, after deep drawdowns like 2008 and 2020, silver outperformed gold by 2 to 3x during recoveries. Yet most investors still chase gold first. This disconnect between perceived safety and actual upside potential is where institutional positioning quietly shifts. The real question is whether this compression signals accumulation or another trap. Next, Francis Hunt unravels the technical structure forming beneath this setup.
There was a squeeze, by the way, that was taking up, and we talk about the 3 impulse falling wedge. And what you quite clearly have is the very steep one, which is typical, the high volatility, blow off into proper slap. Remember, silver got the harsher slap first time. So we often talk about Church's steeple in terms of the spikiness of the first impulse. Then you get more of a flattening. There's some complexity. It's more of a king's crown. It rounds out a bit of convexity. You can see some of the volatility is dissipating, but still relatively volatile, just not as violent as this. You see those 2 candles there were brutal candles. And we had a lot of bleeders on our YouTube channel, moaning at me that silver went down as if it's going to go up in straight lines because we sort of, the silver messiah and now we are the silver bastard. And you said, and we were like, well, we were fortunate to have got out before that. And we even mentioned it on X that we were expecting this to fall. We had a lot of targets here. Second interims were run on big macro setups on HVF method. So we had actually been stepping back. We didn't ride that downside, but a lot of the free views on YouTube did. And it was a case of you should have stop losses and you shouldn't trade off of any signals unless you have all the signals.
Retail frustration usually peaks right before structure starts to form. And that's exactly what this volatility shift signals. As Francis Hunt points out here, the transition from violent spikes to controlled compression reflects a market moving from panic to positioning. In past cycles, especially 2011 and 2020, these phases flushed out emotional traders before major directional moves began. What doesn't get said enough is how many losses come not from bad ideas, but from poor risk control and no stop-loss discipline. This is where portfolios quietly bleed while institutions reset exposure. Next, Francis Hunt shows how this evolving pattern shapes the next phase of opportunity.
So what's actually happening for us is that you're in a creation of a more low vol third move.
Excellent.
And this may or may not bounce here. It may come to the same level as the last low. It could come a tiny bit lower. But when that part is done, we anticipate a break. Now, there are some really high momentum moments where you can have a rushed third impulse. I don't think we've met the criteria for the third impulse, but we sometimes talk about, and this is how we'll be wrong. So for those that ask, you always got to ask, how do we be wrong? You could have a rushed third impulse. Sometimes you can do just that, and it just does a move to the splitter, and that's it. It's very disproportionate to everything else, and typically the best structures have quite a bit of proportion. So that would be a very rushed third impulse, and it didn't come down clearly to the lower basing descending grind line that I've highlighted here. So it's less likely, it lacks proportionality. What you'll also know is we get a concept we refer to as complexity, where you zig and zag, even though overall it's a arc, much like that.
Markets rarely reward impatience, and this setup is quietly punishing anyone trying to front-run the move. As Francis Hunt points out here, the absence of a clean third impulse suggests the structure is still incomplete, meaning premature entries carry asymmetric downside risk. Historically, incomplete patterns, like in mid-2022 commodities, led to false breakouts that trapped early buyers before final consolidation. What investors overlook is that proportionality in patterns often reflects institutional accumulation phases, not randomness. Weighting isn't passive. It's strategic positioning while volatility compresses. Next, Francis Hunt discusses how complexity inside this structure can mislead even experienced traders.
You can see that it shoots a little bit beyond to the upside, then a little to the downside, then a beyond to the upside. The crown element, the spikiness, that's called complexity, the degree that it varies to a nice smooth curve. And it's
Right.
absolutely normal for you to have some of that in the three. So were you to have that, you do a little bit above, then you do a little bit below, a little bit above, a little bit below, a little bit above, a little bit below. But they tend to be a bit smaller. In other words, not as big as these swings
That
that
is
you get.
drastic.
Yeah.
Yeah.
So you continue to see dissipation in the volatility. It's like a calming incident. I mean, we refer to it as the slap in the face, technically, when you get this degree of volatility, because it's kind of like, somebody chatting up a girl and it's all going so well. And then he starts to get presumptuous and puts his hand on her knee or something like that. And then he gets a short, sharp slap in the face. He went too far too soon. And then it's kind of like a face saving, reducing the volatility. I'm sorry, respect your space. What can I do? Anything. And it's all like, it's got to calm all down before he can either gracefully depart or hope to try rebuild his chances. And that's what you get in the market.
What looks like random price noise is often the market quietly resetting expectations after excess. As Francis Hunt points out here, this complexity phase, smaller oscillations after large swings, isn't weakness. It's controlled volatility compression that typically precedes directional intent. After similar post-shock patterns in 2013 and 2020, assets that stabilized like this often transitioned into sustained trends while retail lost interest. The part rarely said is that institutions prefer this calmer environment to accumulate without moving price aggressively. If volatility keeps shrinking, the real move is likely being prepared, not avoided. Next, Francis Hunt unravels why low volatility phases often mislead impatient investors.
You've got this jolt, and volatility dissipates slowly, but it can sometimes return with a bang out of nowhere. So it can detonate. So unlike tides that come in slowly and they go out slowly, volatility is something that explodes from a very extreme low moment and then takes its time like a tide dissipating. So we are probably going to watch it become a bit boring and a bit dull. And you want to celebrate that because that's when everyone goes, it's a boring market, let's go elsewhere. That's usually just before it's about to start moving again. So we
Great
love
point. Great point.
Yeah, extreme low volatility.
Okay, so I have a question on that. With that triangle that you drew, and that's a beautiful triangle. So you're looking to volatility to contract, for lack of a better word, and then you're looking at perhaps a bounce on the lower end of the triangle, and then a breakout on the top end of the triangle. Is that correct? Is that what I'm
Can
saying?
you allow me to be a bit pedantic and correct you a bit?
Please.
Because this will just upgrade your communications on technical matters.
The most dangerous phase in markets isn't panic, it's boredom that convinces investors to look elsewhere. As Francis Hunt points out here, volatility doesn't fade symmetrically. It collapses slowly and then erupts suddenly, catching portfolios off guard. Historically, low volatility regimes like late 2019 or early 2023 preceded sharp breakouts, often when participation had already thinned. What's overlooked is how capital rotates out during these dull phases, leaving fewer participants positioned when the move begins. That's where opportunity quietly builds for patient capital. Next, Francis Hunt discusses how misreading chart structures can distort timing and risk.
Triangles are when you have separate gradients. One has a downside gradient and the other has an upside gradient.
Got it.
They don't have to be symmetrical, so you can have a steep one and then you can have a quite a flat increasing one. That would still qualify as a triangle. When both are downward based, just at different gradients, that is a wedge. So refer to it as a wedge more correctly. I know it looks like a triangle in terms of how you were taught geometry, but in a technical context, we'll refer to it as a wedge because both the capping descending grind line is a descending grind line and the basing descending grind line. And we give them these naming standards to help people get to the subatomic aspects that makes for a wedge. And we call this the splitter, which is the aggregate rate of descent of the entire structure taken to a point. So that is a wedge. Triangles are where one side is upward. It doesn't matter the degree, and the other side is downward. In a technical context, you're not wrong in terms of geometry.
Yeah.
But yeah, I just mentioned that. So, but the rest of everything you said is spot on. We're looking for a dissipation of volatility and form. It gets lazy and it gets quieter and it gets a bit boring.
Small terminology mistakes in technical analysis can quietly lead to big positioning errors. As Francis Hunt points out here, confusing a wedge with a triangle isn't just semantics. It changes how you interpret momentum, breakout probability, and timing. In past cycles, wedges often resolve with sharper directional moves compared to triangles, especially in commodities during 2016 and 2020 recoveries. What many investors miss is that precision in pattern recognition reflects discipline, and discipline directly impacts risk-adjusted returns. Mislabel the structure and you misprice the trade. Next, Francis Hunt shows how this wedge formation shapes the expected breakout behavior.
So I do think there's a chance we roll not too far away in here. I can adjust these lines marginally, but I can't completely cheat this. If I'm wrong, if we're trading at 84 tomorrow, I'm wrong on the falling wedge in terms of my expectation. Then that was your quick rush third. You only had, you had a breakout from the second phase, literally very tight third, and you went straight into the move. And that can happen and occasionally happens. However, we tend to see a much higher degree of compliance to the rule of three. So there's an up and over. It's going to tempt all the bulls in, and that'll really hurt them if it sells off again. And that will be oil rallying and dollar pushing back again. So they're playing you at the moment with this escalation, Straits of Hormuz, and then a de-escalation. Oh, we might be signing peace documents, certain amount, These guys are regulating how much stress they are introducing into the system through throttling. They want to keep it alive. They've got you by the throat. It's a choke point, and they're throttling you.
Markets don't just move on fundamentals. They're actively managed through cycles of fear and relief. As Francis Hunt points out here, this rule of three setup could still trap bullish sentiment before a true breakout, especially if macro signals like oil and the dollar tighten liquidity again. Since 2022, each geopolitical escalation has been followed by short-lived relief rallies, only to reset positioning and volatility expectations. What rarely gets acknowledged is how narrative shifts, peace versus escalation, are used to maintain engagement without triggering collapse. Investors chasing early breakouts often become liquidity for smarter money. Next, Francis Hunt discusses how this controlled volatility impacts timing decisions.
If they kill you immediately, the whole thing's dead and gone. They need you to stay just alive enough. And if the signs start getting hectic, you have the debt markets falling out of the bed, the beginning of a tech rout starting to loom, then they throttle it back again and say, hey, we're making peace and no more things will be let through and no more bombs happening, And then the things start to revert. People are quickly, they go from absolute fear to absolute greed in a very short time, and they start going all frothy again, and then they quickly bring up the fear again. So you need to think of this as almost a regulated process. So I think we'll probably roll over one more time. That's not to say that I'm saying it goes lower. Often inside the wedge, you get a bounce, say on the splitter here at the same level, or it doesn't even come as low. It can go a touch lower, but not too much because this descent here is at that gradient. And that you already popped out the bottom quite a fair bit, and the volatility is getting less.
The market isn't chaotic. It's being paced to keep participants engaged but never comfortable. As Francis Hunt points out here, the cycle between fear and greed is happening faster, with debt stress and tech weakness appearing just long enough to reset sentiment before being walked back. This mirrors post-2022 liquidity behavior, where central banks intervene subtly, preventing full breakdowns while avoiding true recoveries. The wedge compression and falling volatility suggest controlled positioning, not organic stability, leaving investors exposed to sudden sentiment flips. Next, Francis Hunt unravels how timing, not direction, becomes the real edge in this environment.
So I can't tell you how far down, but I'll wait until it starts to bottom, and the market will tell us. And if we make it down here, or if we're here and it starts to go up, it would be better to buy in then. And if it keeps going on up, as I say, and you're at 84 or even 81s, I would say, then it's broken fast. Then I'm a chasing, and that's not a position I like to be in. But then you end up a chaser. But I'm going to show some patience on balance of probabilities that the full structure will play out. So there's going to be don't forget another thing, Andy, we're talking Wednesday. I don't know what day this will be going out. It's Wednesday, the 1st, April Fool's Day. Thanks for having me on Fool's Day. But in spite of that gag, Thursday and Fridays, they tend to warm the fear up again. And we have a quite nervous weekends. That's been a trend we've also noticed. So
patience sounds simple, but in fast markets, it's the hardest strategy to execute. As Francis Hunt points out here, chasing strength after a sharp move often traps investors right before reversals, especially when levels like 81 to 84 signal momentum exhaustion. This aligns with recent patterns where late week sessions, particularly Thursdays and Fridays, reintroduce volatility as institutions reposition ahead of weekend risk. The refusal to chase highlights a deeper truth. Structure matters more than price in uncertain cycles, especially with April volatility historically elevated around earnings season. Next, Francis Hunt discusses how these timing patterns quietly dictate entry success.
Oil tends to go up into the Friday because who knows what garbage might go down on the weekends, and you have 2 days without responding it, and there's all the fear that is things escalating. You don't have to protect against things de-escalating. You protect against escalation. So people position for that. So I just leave that with you. Again, if oil goes up, they are slightly adversarial in terms of how they position now. With the oil going up, we'll also see fear and a dollar going up, and that'll be bad for Bitcoin, potentially softening for gold, and also for the tech stocks again going into the weekend. And bond markets, the rates will go higher and the values down. So let me hand back to you because we've done quite a bit of detail on the silver here.
Yeah, and thank you for all of that. I guess the big thing I take away from this is the market's going to tell us entry points.
Weekend risk isn't priced on fundamentals. It's priced on fear of the unknown. As Francis Hunt points out here, oil rising into Fridays reflects hedging against geopolitical surprises, not actual demand shifts, which then cascades into a stronger dollar and pressure across risk assets. This chain reaction, oil up, yields up, tech and crypto down, has repeated multiple times since 2023 as macro uncertainty dominates positioning. Investors often miss that this isn't random volatility but systematic de-risking before illiquid periods, impacting everything from bonds to Bitcoin. Next, Francis Hunt shows how these intermarket signals quietly guide smarter entries.
If you're a trader, it's just you got to be really, really disciplined to wait for the markets to tell us and the charts to tell us what are the great entries. Let's talk about the miners, the mining ETF.
Sure, let's do that. I do just want to say, with this kind of bounce on gold and gold leads, I really think the 3.5 grand callers are going to be caught short. I don't think you're going to be seeing that. But who knows? It will take a different degree of crisis. That means they're prepared to let everything go, all fall down.
The real risk isn't missing the move. It's entering without confirmation in a manipulated cycle. As Francis Hunt points out here, discipline around entries becomes critical when gold leads but sentiment extremes, like $3,500 calls, signal crowded positioning rather than sustainable upside. This reflects a broader pattern where gold rallies ahead of crisis expectations, but only delivers outsized gains when systemic stress, like 2008 or 2020, fully materializes. Without that level of breakdown, upside may be capped while miners lag expectations. Investors chasing extremes often ignore this nuance.